Hello, and welcome to Adam's Swing Trading Masterclass, Unit number 8, Swing Timing, Entry and Exits. Disclaimer, any views or opinions in this course are strictly my own. I'm not a financial advisor and this is not financial advice. Tactics, strategies, philosophies, and fundamental principles presented here are mutually exclusive with material presented by the other professors. This is because my methods target different goals using different data. Double disclaimer. I know it took me forever to come to terms with making this unit, because I know for a fact it'll be the most widely misused in the entire masterclass. I know for a fact that most of you will literally ignore all my other advice and only use the information delivered in this presentation. I cannot stress enough, no one unit should be taken in isolation. You have been warned. Triple disclaimer. This presentation is not exhaustive. This field of study is infinite in complexity. I feel like I could go on forever and it would never be completed, so I've stopped here in its current form. All I'm doing is providing you with what I believe is the current best single approach. Other methods may be discussed in the future. Alright, so if we're thinking back to unit number 1, today is finally the day we're going to be looking at some technical analysis. It's going to be a bit different to what you guys are used to. It's my own personal spin on it. I believe it's the best approach, so we'll have a look at that. Our learning objectives for today: problems with trends and mean reversion, trend following itself, profit taking capture, that's going to be along the lines of a mean reversion approach, and some additional considerations at the end. So problems with trends and mean reversion. As most of you, I would like to hope, have seen in the professor's notes, you will understand that I only see the market in two ways. There's only two types of analysis. Is it trending, going up or down, or is it mean reverting? Is it too high or is it too low? Everything outside of these is pretty much a waste of my time. If you remember back to some of the earlier ones, this is essentially the method that I'm trying to use in the market. Basically a trend following strategy with some incremental profit taking at the extremes. So everything that we're going to be looking at today is going to be within the context of this. So do your best to memorize that and put that into your brain, because it's going to contextualize what we're looking at today. Trend following. So we're going to look at what our expectations are when running a strategy like this. This is the dream. We get a nice entry if we have, say, a moving average, which defines for us a rule that we want to follow. And then as it crosses back below the moving average after a sustained trend, we exit the position. This one here's a great example. Random moving average, it was probably a 200-day or something. And it's a nice 5,000% gain there. Juicy. Trend following, what the reality actually is like. When you have a moving average like this and your rule says, for example, that the daily close is the means of which you determine whether or not it's a buy signal or a sell signal, you can see here that if you take this rule strictly and apply it as written, then you'll have multiple false signals. You'll have a sell here, a buy here, a sell here, a buy here, sell here, and you can see that between these signals, there is really no profit being realized. There's only tiny little trades going on here, and a lot of them are flat, which is not what we're looking for. You can see that selling here and buying here, that was decent, but the spread between this entry and that exit, you can see that there's only a tiny amount here, and the price went all the way back down and back up again. Same here. This one's even more perfect. Flat, essentially. And then you have multiple whips over on this side, on the right-hand side here. So basically a complete disaster. But we're still following the explicit rules of this hypothetical trend following system. So how do we improve something like this? We're going to be looking at that. And mean reversion, the dream. Mean reversion, relative strength index, the RSI is a classic one. What we imagine in our mind is when we have a signal that's coming above our threshold above here, we sell, pretty clear signal, and then we have a little dip below the bottom threshold, buy it back. If it's in a downtrend or whatever, or maybe we even buy here and sell here, and you can see that that was basically risk-free. Buy there, sell there. Even though it was not a huge trade, you didn't lose much money. You made a little bit of money. But yeah, if you're trading the downtrend and you were going short, long, short, and then you closed out your position either here or here, again, Awesome. Massive, massive trade. Or potentially buying here, selling here, above and below the thresholds. Beautiful trades, beautiful trades. Plenty of money being made, tons of money being made. That's the dream, right? But let's have a look at the reality. Oftentimes, you'll find that things like this will actually happen, where you have the RSI go above the threshold, trigger what in your situation would be a sell signal, and then just simply proceed to keep going up. Imagine if you were taking profits here, or if you were selling here, you were trying to sell here, and you just saw sustained losses, not a single signal below the bottom threshold to tell you that it was time to get out. It just marches onwards. Or alternatively, you're longing, so it's oversold and you buy here, and then the thing just keeps going back down again. You never get another signal to escape that position, and you just get basically wrecked. So what does this all mean? All methods of technical timing have flaws. There is no indicator that will guarantee you make money with a 100% hit rate. Virtually all are below 50%, actually, due to algorithmic data mining. This means we must diligently perform analysis using multiple techniques to gain a holistic, probabilistic view of the market above random chance. Often, new investors will become obsessed with the perfect entry and will obsessively seek the one ideal indicator for catching every move. Not only does such a tool not exist, people also attempt to mix styles, swing trading with scalping, for example, in an attempt to overcome this inherent obstacle. Done naively, all this does is increase complexity with no increase in signal. We see this tons in Hustlers University. More problems. Another problem I found is that because the market is fractal, intelligent students will recall my previous behavioral economics lecture at this point. No one actually defines beforehand what they're looking for. This leads to people drowning in a sea of panic and confusion with every price move on every time frame, which, as we know, is infinite. Price declines by 3%. Is now a good time to buy? RSI on the 30-minute chart is oversold. Price declines 15%. Same thing. RSI on the 4 chart is now it's a good time to buy. Price declines 40%. Again. People that they don't know what they're looking at. All of these observations are subjective without an anchor. Novices hit me up asking, price is dipping on a 1-hour chart and I'm a long-term holder. Is now a good time to buy? If you can't see the issues that I'm trying to describe here, you are the problem. This is the equivalent to pulling out a magnifying glass to inspect a paint chip on a supertanker that's about to sail across the Pacific Ocean. Not only are there 100 higher considerations, it's not a constructive use of an individual's mental capacity when starting out. Over-optimization is not viable until you have achieved mastery at a single scale across all analysis methods. This may take some time. It took me, personally, years. So, trying to mix styles as a novice equals hyperspace levels of retardation. This is what I see every time I try to see somebody new to the game trying to take on too much work and try to cover too many different styles at once. You're willingly being ignorant, as far as I'm concerned. Orientation. So, how do we solve for this? Much like celestial navigation, one must have an anchor point or a north star in which to contextualize the behavior of the market. The trade-offs for different anchor points are apparent. Short time frames, more opportunities, more work. Longer time frames, less opportunities, less work. I choose the daily chart as my North Star because I've got better things to do than to sit around and look at charts all day, even though that's what I actually do. I actually have other work that I want to work on. I'm at the computer, but swing trading suits my personality style, so I want less work. All right, now we're starting to get into the juicy stuff. This is what you've all been waiting for. So, as far as a trend trading strategy, what we want, now that we have a one chart resolution, which will help us eliminate all the confusion so we can proceed in a clearly defined manner, what trend following method should we use? My requirements would be it must provide clear signals for direction change, must be simple enough to prevent paralysis from overanalysis, must be testable for significance, and must provide a perpetual signal, either be always being long or short. So recall what we're actually trying to prevent here. We're trying to prevent multiple whips, and while this provides signals, it doesn't really give us a testable edge. This is just discretionary. we're looking at the screen and saying, well, these are the rules, and we know for a fact it doesn't work, and it could fuck us up multiple times. So what are we going to do to improve on this? We're going to apply a moving average crossover strategy. Now, I know some of you guys might immediately be looking at this going, hold on, this is a little bit too simple. Bear with me. We're going to get extremely, extremely sophisticated with this. So for you guys who are advanced, hold in there. Just take a deep breath. And for the novice guys, a moving average crossover strategy essentially takes moving averages, and on every daily close, it gives you a signal, whether it's long or short. The benefit of using a strategy like this is that it gives you discrete signals. So in the scientific sense, discrete being a single moment in time, this is highly beneficial for us because it's not confusing. It will not whip up and down. It will not repaint, which is a phenomenon with strategies where it will give you a signal because it reaches all of its criteria, and then it actually takes back that same signal. So we want a strategy that will not repaint, a strategy that gives us discrete moment in time signals, is long or short, testable for significance, and also doesn't whip us around like the previous screen, as you guys will remember. So why moving average crossover? Provides clear signals. It's the simplest trend model in existence. So for beginners, this is a good one to build from. And even for the advanced guys, we can get way more sophisticated with this. It's plenty of work later on. We'll get around to that. TradingView allows for back testing with different variables and provides a perpetual signal. So I'll just skip straight to the meat and potatoes of it. What I've done is I've got this moving average crossover strategy for you guys that you can copy from me and implement straight away. Now, you can see here that we've got the statistics for the strategy down the bottom. This is actually an old one, as you can see. It doesn't incorporate that latest rally that we had over here. That's all right. We'll get around to that in a minute. But yeah, after doing some analysis, you can see here we've got a nice percent profitable percentage. We've got a good profit factor. Ignore all this other stuff. Max drawdown, yes, it can be a problem. This is an unoptimized algorithm, though, as far as multiple factors. This is a very simple model to run off, and we can improve this. So we'll get into that later. Ignore the average trade. Ignore the net profit. Ignore the average bars in trade. Actually, average bars in trade isn't so bad. You can look at that and say, look, I'm a busy man. I don't want to spend too many days changing my positions. So you can look at that and say, I prefer higher numbers. But really what we're looking for is the profit factor. We want to make sure that, and the percent profitable, we want to make sure the probability of having a winning trade and the magnitude of the winners relative to the losers are bigger. So I've spent my time using the research that I've done with my previous research and stuff to basically build this for you. And this is the secret sauce right here. I want you guys to pause this and take a note of that. Moving average crossover strategy. Close 24 EMA, 39 EMA. Pause this, take a note of that, move on. And then we have the Ethereum strategy. Based on Kraken. I'll just go back and remind you guys this strategy here is on Bitstamp. Just in case there's differences between the price data on the different exchanges. I know for a fact that a lot of them won't be directly transferable. If you bring this strategy onto Kraken, it'll be slightly different. If you bring it onto Coinbase, it'll be slightly different. Same thing with the Ethereum strategy. Kraken, Coinbase, Bithumb, or fucking Binance or whatever, all these stats are going to be slightly different for each exchange because their price feed data is different. But yes, same thing here. We have the Ethereum strategy. Good profit factor, percent profitable. Not looking too good, but we're going to dive into that in a minute. Ignore the max drawdown, average trade, average bars, all that other shit. Take note of the secret sauce, which is the calibration for this strategy. Pause that, write that down. Okay, so where do you come into the picture? You can see here that I've clearly done some of the work for you. However, this does not mean you can turn off your brain. The work is not over simply because I've given you pre-built strategies to blindly follow. Why? Because no single strategy is perfect, and edges must be layered with other edges in order to extract the maximum value and increase the chance of success. One moment, I'll just take a drink. Why not other strategies? Now, this is getting more advanced. At the end of the day, you can absolutely go ahead and test a number of different strategies, trend-based strategies, not just moving average crossovers. As a matter of fact, I would recommend this. Pull up the DMS, Arun, MACD, slow stochastic, etc. strategies on TradingView and spend a couple of hours testing different variables and take notes on the ones that work the best. If you find uncorrelated models, even better. Keep notes on all of the best results. You may even be able to combine more than one of these to enhance the signal. We're going to be looking at this. If you find any good ones and you're not quite sure what you're looking at, send them to me and we'll have a look over the results to review. We're going to be doing some of that in this lecture, so you'll probably be able to do it by yourself, but I'd still like to know if you find any good ones. Strategy behavior. Okay, so we can actually dive into the statistics of these strategies and extract additional alpha from them. So let's look at the Bitcoin strategy. If we have a look up here, this is a more recent one. We have the profit factor. We'll start the profit factor. So 5.996. Yes, it's good. It's good. But what about these two columns over here? If you scroll up to the top of this, which I can't because it's just a screenshot, it gives you the long and it gives you the short trades. So they've actually batched the long and short trades in here so that you can actually look at the different stats between them. If we look at the profit factor, look at the discrepancy between longs and shorts. We have a decent profit factor, but like 90% of it is coming from our longs. And fundamentally, this makes perfect sense because cryptocurrencies are an inherently asymmetric asset class. The longs are always going to go up far higher than the shorts. And that's basically the most powerful effect that we're trying to take advantage of. So what else do we have down here? Number of winning trades, more winning trades on the longs. Number of losing trades, less losing trades on the longs. Percent profitable, more profitable on the longs. Ratio, average wins to losses, 8-1. You can just see average bars in winning trades, a lot more bars in winning trades than the shorts for the longs, and the average bars in losing trades, 14-30. It is clear here to me that if you wanted to extract the maximum value out of this strategy, that you would only take long trades. This is the implication. Only take long trades. And I would agree with this analysis. I would agree with my own analysis. How's that for irony? But yes, and I would be ignoring the short trades where possible. Now, all this really does is decrease the amount of signals that you're actually going to take, and it's probably going to be a bit too slow for you guys, especially if it's on the daily. But what if we use the Ethereum strategy as well? It uses different calibrations, so it's going to fire at different times. So we might be able to find some additional use there. If we're adding extra strategies, we'll get more signals and we'll be able to have more opportunities to make profits. So let's look at the Ethereum strategy. Same as before. You'll actually see here, and isn't this fascinating? The profit factor is positive, but the only trades on average that made money from this strategy were the longs, and the longs were exceptionally profitable. 25-0. If that doesn't scream if that doesn't make you believe that this analysis process is super useful, then I don't know what is. Let's look down here. What do we got? Number of winning trades, 11-6. Number of losing trades, 11-15. Percent profitable, 50% to 28%. Ratio wins to loss, 25 to basically 0.5 maybe. Average bars and winning trades, 106-91. Average bars and losing trades, 19-24. It's clear to me that the same strategy must be applied to Ethereum. Long-only trades, if you're using this strategy, please. So we're talking about buys and sells, no shorts and covering for the advanced guys out there. So we're going to be memorizing that and taking it into the future. The implication here is that you can simply throw away the shorting component of the strategy and follow the long component for the higher probability signals. Okay, moving on. Profit taking, capturing positive returns. Okay, we're going to cover profit taking in the holding context first. just as a preparation for the advanced method. So, does this chart give you guys PTSD? I think it should. You probably didn't take profits at all-time highs. So let's briefly talk about buy and hold profit taking so that we can apply the learnings to our new strategies. Historical all-time highs have been a great place to take profit. You can see here with the white dots, the clustering of the all-time highs are precisely at the moments where you'd be thinking to yourself, man, it's time for me to take profits. I mean, isn't it just so obvious when you zoom out? I would even give myself an uppercut at times for looking at this and thinking to myself when it's going up, yeah, you know what? I'm not going to take profit here or here or here, and I'm not going to take profit here or here or here because I think it's going to go a lot higher. What we actually need to do is determine strategies for taking profits at these all-time highs. These quite literally the perfect moments to take money out of the market. Wouldn't you agree? So let's look at that. The main advantage of the crypto market is the asymmetric return profile, which means that we naturally receive many more all-time high record highs than a normal market. These highs will also be much higher, proportionally speaking, than any comparable market such as stocks. Logically, this is a great place to take profits. However, the natural inclination for most people will be to ask, what if it hits all-time highs and it keeps going higher? Great question. In most cases, it likely will, all the way up until it doesn't. So how to best take advantage of this? Buy and hold method 1, linear profit taking. For each all-time high, take a fixed amount of the portfolio size and convert it into cash, say 1 or 2% each time you get an all-time high. Pros, allows the portfolio to grow at a faster rate during bull markets if the amount is low, and it has an ease of application. Cons, it does not scale or discriminate between moments, thus leading to conservative profit taking when the amount is too low. Restricts the portfolio from growing at an optimal rate if the percentage amount is too high. So clearly this can be a problem. Probably not the optimal application of this method. Buy and hold method 2, exponential profit taking. For each all-time high, start at a fixed percentage of the portfolio and convert it into cash. For each subsequent all-time high, take twice the previous amount. Reset for any drawdowns or declines, greater than 25 to 30%. For example, we go 1, 2, 4, 8, 16, 32. You can see it doubling each time, exponential by definition. Pros, allows the portfolio to grow faster during a bull market if all-time highs are happening infrequently. Trims the portfolio most aggressively after sustained periods of extreme performance. The cons, and this is a big one, it only allows, in only 7 to 8 days, the model calls for a 100% reduction in the portfolio. Now, the main problem here is you can see that with up to 74 subsequent all-time highs at different bull market stages, the exponential method is not sustainable when the portfolio exposure goes to zero after only 8 days. The drawdown rule helps reset this, but it doesn't really prevent the problem entirely. Even if you're clustering these, your portfolio exposure would probably go to zero there. Oh, geez, I don't know if you can see the cursor. It's so small, but you'd be missing out on a massive part of the market run up. Okay, so we're going to get a little more appropriate now. So buy and hold method number 3, incremental profit taking. Like linear and exponential profit taking, but with addition instead of multiplication. For each all-time high, start at a fixed amount and convert to cash. For each subsequent all-time high, take an additional fixed amount. Should have that saying a fixed additional amount. Reset for any drawdowns or declines below 25 to 30%. Okay, so that would be the equivalent of going 1, 2, 3, 4, 5, 6, or 2, 4, 6, 8, 10, 12. You can see that we're not doubling, we're just going up by 2s. Pros, allows the portfolio to grow faster during bull markets if the all-time highs are happening infrequently. Trims the portfolio most aggressively after sustained periods of extreme performance. Trims the portfolio most aggressively halfway through the return profile instead of at the end. So what I've done here is I've taken just a simulation of what these different profit-taking profiles would look like. Obviously, logically, we want our return profile to kind of curve off hardest towards the end where the market is running up the hardest. So we're actually going as aggressive as possible. But finding an algorithmic method of doing this, at least one that's easy enough for everybody to apply, can be quite complicated and difficult. So using the most basic ones, we can see the trade-offs a little bit easier using this chart. So the linear one, very easy to start off with. If we're just taking out, say, 2% of the portfolio, and the portfolio is growing at 7%, I came to this, all of these are simulations using a position that's growing at 7% per increment. I came to this number by figuring out the geometric average of the last Bitcoin bull run. It's not a perfect means by any method, so just take it with a grain of salt, but it was just my method of simulating a portfolio that's growing in the background while we're also taking out profits at the same time. So linear, you can see that with a 2% reduction and a 7% growth in the underlying portfolio at a geometric rate, it actually is not aggressive enough to reduce the portfolio at all. So it actually just keeps growing to infinity. The exponential method, you can see here, it drops off super fast, like only after 8 or 9 days, we basically go to zero. So far, far too aggressive, especially if we're doing an all-time high method where we have up to 30 all-time highs in a single bull market. So using the incremental +1 strategy, we can see here that the portfolio still grows for the first, say, 10 days, and then it starts cutting more aggressively through the middle of its return profile. So between days, say, 10 to 20, we're actually seeing the fastest reduction in the portfolio size, and that goes down a little bit more at the end. If we increase that to +2%, an extra 2% per day, so that's 2, 4, 6, 8. The fastest reduction in the portfolio return profile is actually between days 10 to 20 or 10 to 15, so it's a little bit earlier. You can see that, and the portfolio exposure essentially goes to zero after day 15 to 20. So that may be a bit too aggressive. And another alternative, this was a bit of a wild card I threw in here, incremental. It's kind of a mix between incremental and exponential. Instead of doubling everything, we're only going up by 10%. So you can see that starting at 1% essentially and increasing by 10% each time, it doesn't cut the portfolio very hard at the beginning at all, and then towards the end it cuts very aggressively and brings the return profile down to zero at the end of the 30 days. So there's some problems with this though. A caveat here is that we're curve fitting for the most recent bull market by tuning the results for specifically 30 days. Other bull market peaks won't abide by these rules, so the assumptions will be wrong. I'm just showing you how to run the experiment. With that being said, we have to choose a method. Personally, I choose the incremental +2 method if I was using a long-only strategy. That would be this green one here. Maybe use a little bit of discretion depending on what the fundamental analysis looks like. But for me, the +2 method I think makes the most sense because I think we're going to see infrequent bull market peaks from here on out. But who knows? This is just a simulation of the different models that you can use. Okay, so now we're getting more advanced now, more appropriate to what we're actually going to be using within the long-short context. We're getting closer to the systemization we're going to actually use here. So, something you guys may have noticed using the strategy is that we actually have a lot of the returns within these strategies that are being unrealized. So we have shorts, and then we have a dip over here, and then it goes back up, and then it changes the signal. Or it was long over here, and we have all of this, all the spread between the short position and the peak of these spikes here were all unrealized gains. And those were just kind of gains left on the table. We see that over and over and over again. We have a round trip. It goes short, round trip, all the way back up to long, unrealized gains. Long, round trip, all the way back to short again, unrealized gains. Again and again and again. You can see here that between a few of these positions, the strategy itself wouldn't have made much money. But had we taken profits or tried to capture some of these unrealized gains, we could have scooped these profits off the table and added those to our kitty. which I think, at least for me, makes perfect sense. So this is how I try and solve the problem using lots of different strategies. You see, a lot of overbought, oversold indicators have a single signal, but this one here, this one is called the DJT Williams VIX Fix. And I think that this is a great example of an indicator which, taken in the context of a profit taking and not an entry and exit, makes for a great incremental profit taking guide on both sides of the long short spectrum. And you can see here, it triggers on individual bars. So if we have a multitude of these profit taking bars, then we can go, I'm going to reduce the portfolio or the position by 2, 4, 6, 8, 10, and you can keep going up. And it happens quite frequently. So you're always getting opportunities to take some money off the table and actually enhance this strategy. Something that I realize right now that I forgot to put into this presentation is that these bars isn't actually how the indicator shows up. This is just a highly modified version of the indicator that I've made. Yeah, sorry, I fucked up. It actually appears down the bottom of the screen as a bit of a strip, and it doesn't have these colors, but the signal is still there. Anyway, moving on. It isn't perfect, but it's good enough, which I think over a long enough period of time is sufficient. We can see here that, we've got little amounts of profit taking here, telling you to trim some of your positions, and some positions over here. Again, like I said, it's not perfect, but I think that's a great method of finding medium-term highs where you should be taking some money off the table in the context of this profit capture on both sides of the long-short strategy. Again, on Ethereum, great example of profit taking at all-time highs, giving you the opportunity to take your money out. And again. Okay, additional considerations. Okay, so this is a quick diversification refresher. So I just want to cover the fact that if you have one asset in your portfolio, or as we're going to explore, strategy, if you have one in your portfolio, you're taking on basically all of the risk of that strategy. But if you add a second asset or strategy to your portfolio, you have this massive, disproportional decrease in risk relative to the third, the fourth, the fifth, the sixth, the seventh additional asset or strategy that you put in. So to me, this would appear to say there is a lot of extra alpha sitting on the table, but all you need to do is add an extra strategy. Now, I'm hoping that you're having an epiphany moment, and right now you're thinking to yourself, holy shit, maybe that's why Adam gave us 2 strategies instead of 1. You'd be correct. Now, diversification, asset or strategy. This is getting a little advanced. Now look at this chart here. If I take away the labels, you don't know if the return series are from assets or strategies. The computer doesn't know either. As you guys may know, some of these are bond charts and some of these are stock charts. And the ones in between are actually the diversified portfolios. And yeah, if you look at some of these lines, you combine stocks and bonds together, there's a massive suppression in volatility, and you gain that upside as well. So this is like what we're trying to do with the strategies. Statistical example of how it works in cryptocurrency. I use Portfolio Visualizer for this. If you guys want to tinker and do some of your own analysis, just go to this website and create a free account with, like, I don't know, use a fake email address or something. They'll give you some free trials, and you can pump in different assets. It's not perfect because the return series for the Ethereum and Bitcoin market price don't go back very far, which I think is just bullshit. But yeah, I sometimes put in my own return series in here. Actually, I do. So we're going to see a little bit of that later. But this is just an example of how to think about it. So what we have is the portfolio allocations going forwards. Just an example of if we put Ethereum and Bitcoin together, have them working together in the context of not only Bitcoin in isolation, but also what that would look like relative to a strategy. So On the right-hand column here, we have the Bitcoin market price. I think this is going back to like 2016, I believe. So you can see the annualized rate of return, but all these different things, standard deviation, so that's the volatility of the price, maximum drawdown, blah, blah, blah. And what we have here is diversification. On the left-hand column, we have Ethereum and Bitcoin put together. So if we put Ethereum and Bitcoin together, and this is just a diversification example, we can see here that not only is the growth rate increased, fairly significantly. Yes, we have increased the risk slightly. The standard deviation has gone up marginally, not very much. The max drawdown has gone up very marginally. But look at this. This is the most fascinating thing. The Sortino ratio and the Omega ratio have both gone up by quite a large jump. We have 3.5 to 4.5, 3 to 3.8. Now, these ratios, the Sortino and the Omega ratio, I mean, we have the Sharpe ratio here as well. We can look at that one from previous studies, which the previous lectures, which you guys will recognize. As we get further along this, you'll realize this becomes less relevant because the Sharpe ratio actually doesn't discriminate between the different sides of the probability distribution of the standard deviation. We only really want to consider negative deviations as being risky, not the positive deviations, which is what the Sharpe ratio does. So Sortino ratio is actually a more appropriate measure of risk-adjusted return for the cryptocurrency market. Omega ratio is even better than that, and we'll explore both of these. What I'm trying to say here is that while you do receive a little bit of extra risk by putting Ethereum in there, because it's a more volatile asset relative to Bitcoin, you're actually receiving a massive increase in the rate of return relative to the risk that you're getting on. So that's what these ratios represent. So what does the Sortino ratio represent? The actual calculation of it here is the expected return, that's the geometric return or the compounded annual growth rate, minus the risk-free rate, which we can essentially say is 0, divided by the standard deviation of the negative returns. So if we're looking at the probability distribution of the asset returns, we're actually only taking the downside volatility segment of the probability distribution in the Sortino ratio, which I think makes sense. You want to have the ratio of the returns over the risk being defined as negative deviations, because think about it on the other end of the spectrum. If we have upside volatility, that's beneficial. We want massive gains. We want the biggest gains possible. So we don't want to be punishing the return profile. We don't want to be punishing the ratio because of that. And that's what the Sharpe ratio does essentially. The Sharpe ratio optimizes for smoothness. The Sortino ratio optimizes for upside relative to the risk. So moving on to the Omega ratio, the Omega ratio is actually even better than this, even better than the Sortino ratio. What we're actually doing is we're getting the cumulative probability distribution function and setting a benchmark rate of return. In this diagram here, it's set to 0.75, but I set mine to about 0%. So I'm isolating the area of all the negative returns and the area of all the positive returns. You can see here it's kind of represented in the same one. I always set mine to 0. And what this is doing is this is actually canceling out, or you could say taking into consideration all the kurtosis and skewness of this probability distribution and converting it into an area function, so that what we can do is actually take the purest representation of the risk and reward and find out what the optimal ratio between those two is. Whereas the Sortino ratio actually doesn't consider the skewness or the kurtosis of the probability distribution, whereas the Omega ratio does by converting it into an area function. So that's all very complicated. What I'm trying to get at is that the Omega ratio is actually a more optimal method of determining the risk and reward profile of an asset or a portfolio relative to the Sortino ratio, and the Sortino ratio is an improvement on the Sharpe ratio. So for cryptocurrency, in order of importance, we go Sharpe, Sortino, Omega. And as a function of that, what we have here is the Ethereum and Bitcoin put together as a maximum omega ratio portfolio, and we have the Bitcoin market price here. And you can see here we have excess returns and a very minimal increase in risk. And that was reflected in the statistics that we saw here on the previous slides. So let's take it one step further. Now that we have a model strategy, how can we pump that into this optimization and have a look at it from there? Now, what we have on the right-hand side of the column is the Bitcoin market price versus my personal Bitcoin trend tracking strategy. Note, this is not the one on the previous slide. This is my own personal one. This is because I already have the data ready to go. And to be honest with you, I'm too lazy to extract this method and do all the Excel data crunching and everything. You guys want to do it, you'll have to do it yourselves because I just can't be fucked. I've already done it. It's a long process. It's not impossible. It's just labor intensive, and I'm just so fucking busy. So what we have here is the Bitcoin market price, and this is a Bitcoin strategy. Okay, so this one's different to before. This is not Bitcoin Ethereum. This is just Bitcoin itself. It's equivalent of a trend tracking strategy, and it looks like this. Okay, so we have the raw Bitcoin price, and then we have the Bitcoin strategy. Ignore the optimization for the omega ratio. This is the price returns. We're not optimizing for anything. I'm just showing you the difference between a strategy and the Bitcoin returns. So not only do we have a large increase in the annualized rate of return using a strategy, also these numbers are going to be different to the previous ones because this is from a different date, taking the starting date from a different point. What else have we got? Maximum drawdown. Maximum drawdown of my strategy is a lot less than the raw Bitcoin price. The Sortino ratio is significantly higher. The Omega ratio is significantly higher. So we can say that using a strategy is superior to just buying and holding Bitcoin over any period of time. Moving on. And you can see this, if we're using a strategy that only extracts positive price momentum or potentially hedges on short downside movements, it's going to outperform Bitcoin. Pretty logical. Now, if we take in diversified strategies, so this is the strategy, this is my Bitcoin strategy from the previous example now, and what I have here in this left-hand column is actually the combined Bitcoin and Ethereum strategy put together. So again, these are my personal strategies. You'll need to refine yours to get to this level, extract the data, do whatever you need to do, pump it through the programs. Because it's just too much work for me to do at the moment. I can't be bothered. So this is the Bitcoin strategy from the previous example. We can see it's taken from a different starting date point. Again, I know, super annoying. But yes, the returns for just the Bitcoin strategy, about 200% per annum. Standard deviation, we'll move on to that in a minute. Max drawdown, 22%. Sortino ratio, omega ratio. You can see here that by combining the Ethereum and the Bitcoin strategy together, not only do we get a significantly higher rate of return, a lower drawdown, but we also get a massive increase in the Sortino ratio and a massive increase in the omega ratio. This is indicative of having strategies combined together as being far more effective. This is also, I must stress this point. I almost forgot to mention this. These strategies, when combined together in a portfolio, they're being rebalanced monthly. Which means that on the first of every month, you're bringing the weightings back into alignment with each other. So whether you're going 50-50 and they get a bit out of whack, and you bring it back to 50-50 at the beginning of every month, that is a superior strategy to just letting them go. The rebalancing reduces volatility in the portfolio and increases performance. So here's an interesting little statistical anomaly here. How do we explain this? Look at this. The standard deviation is actually higher in the improved strategy, in the blended diversified strategy. The standard deviation is actually higher than what it is in the Bitcoin strategy. Now, in traditional finance, the standard deviation is said to be the risk, which is the variability of the price returns. However, if we see the maximum drawdown has actually been reduced. So how do we reconcile these two numbers here? It's simple. The standard deviation, if you remember from my previous slides, I said it doesn't discriminate between the down and the upside. All we're looking at is actually a representation of the increased upside in the portfolio, which is the reason why the Sortino ratio goes through the absolute roof, and yet the Sharpe ratio doesn't. You can see there's only a very small increase in the Sharpe ratio, but there's a massive increase in the Sortino ratio. This tells me that the increase in standard deviation was actually variability being added on the upside, which probably contributes to these massive extra returns, which to me makes perfect sense, at least. I think that that's quite a funny statistical anomaly there, which just goes to show that the Sortino ratio and the Omega ratio are the superior methods of determining the risk-adjusted performance of your strategies. And this is what they look visualized together. Now, if you just compare these returns to the buy and the hold strategy or the Bitcoin strategy itself, just by itself, you can see that not only are we making more returns, but also the return profile is smoother. And this, to me, is quite an important thing to consider, because it's going to make you feel a lot more comfortable running the strategy. You're not going to have as many emotional problems because you're seeing money come in more regularly. It's going to smooth out the bumps in the road. So I think that that's an interesting behavioral consideration to have on this as well. The point I'm trying to get to is that it's good to have a working strategy, but it's exponentially better to go a step further and use two working strategies with ideas on how to improve them and combine them for maximum profit. Considering all the combinations you can make with the other strategies, there's probably enough work here to keep you occupied for the remainder of your natural life, but we're still not done yet. We've got a little bit extra. Knowing when to ignore certain signals. So, as you can see, we try to eliminate as many discretionary variables as possible, but often there are credible external factors that confound the rules we create to manage these positions. A good example of this would be the introduction of Dan's dip buying bot, and or a complex on-chain data report signaling a major rally is possible. Upon receiving these indications, we need to carefully weigh the relative importance of trend following and mean reversion tools, which are designed to work in all situations, against the power of specific tools, which are designed to work in specialty situations. More specifically, if the on-chain data suggested a bull market and Dan's dip buying bot was triggered, I would cover any hedges I was in and I'd buy the dip, despite the trend being negative. Likewise, if we're in a rally and Dan's take profit bot was signals, then we'd close out the long positions or hedge, despite the trend still being bullish. In a sense, this is still systematic trading, whereas the on-chain report example is more discretionary. We must be careful when using discretionary analysis. Remember, our systems are built to protect us from ourselves. If there are additional profits to be made, we should systemize them instead of making it discretionary. So try your best to maintain discipline and remain hands-off. If you want to, modify the system and your rules instead of being tempted to make discretionary movements or discretionary decisions. Another tip, unpopular chart resolutions may contain hidden alpha, the 12-hour, 2-day, 3-day, but not the 5-minute, 15-minute, 2-hour, etc. Often, you'll find more alpha on higher time frames than on lower time frames due to the time value of money effect. Related to the academic principle itself, this is where the battle in algorithmic strategies over short periods of time is more intense, because the money made closer to the present can be compounded for longer and is therefore worth more on a time-weighted basis. This may not make sense to some of you. This may not make sense to some of you, but I can assure you, if you try to apply any of these strategies on a lower time frame, you'll quickly see what I mean. Strategies do not work on short time frames in the realm of the highly sophisticated hedge funds. So here's the summary. Indicator limitations must be remembered. Don't mix styles until you've achieved mastery. Have an anchor time frame. Perhaps use the daily. Use my strategies to prevent discretionary trading and to remove the human element from the process. Test additional strategies and collect useful ones. Study the strategy statistics for secret performance. Understand different take-profit styles. Remember, none are perfect, but some are useful under specific conditions. Trend strategies usually result in a lot of unrealized profits. Use a take-profit strategy to capture these. Diversification is a superpower. Not necessarily the multi-asset type, but the multi-strategy type. Combine strategies. Incorporate Dan's dip bot and take profit bots for an added boost. Test different resolutions, but don't go too low or you'll be wasting your time. Prepare for Unit 9, where we attempt to systemize everything we have learned so far. If you have any questions, jump into the Kripto General chat or Kripto Questions and hit me with the @tag. Thank you very much, everybody, for listening to the lecture, and my apologies for making you wait so long. Like I said, this lecture itself, I could have gone on forever. After doing this lecture, I'm already exhausted. There's so much additional stuff. Like, we're just only scraping the surface, but I'm trying my best to give you guys the specific actionable alpha you need. So generally speaking, this was the timing component of the masterclass. And we've kind of touched on the sizing component of the masterclass in previous lectures. I'm going to be trying to combine these together and guide you guys into the systemization process using both sizing and timing so that you guys can make your own system. Bear with me and I'll get it out to you guys as soon as possible. Thank you very much.